Happy Saturday and welcome to another session of our weekly market analysis. I hope everyone is doing well and have been enjoying their weekend. Uh, as always, what we are going to do is review the economy, what kind of a week we had and what to look forward to. But of course, the main interest is looking at the markets. What kind of a markets, where are we standing now and where are we going? I do have some lessons in emerging markets and lessons of the week, and we review the trade of the week. And of course, we always look at the squeeze and upcoming earnings. Now, before I start, I think for this week, the theme of the week, I put down critical thinking. As you know, this is our fourth year with our broadcasting. And as you know, my whole goal has been to make sure we have independent thinking and we are not following what the media is telling us, whether it's domestically, whether it's internationally, and we want to be in control of our own destiny in a way of a sound analysis and sound thinking. So you will see this common theme today in our lessons, in our analysis of the markets and how the markets react, and whether that's the reality or it is the message that the markets are perceived receiving. So the five themes we will be talking about, the five topics I'd like you to pay attention. Of course, last week, the big news was the CPI and the PPI report. And obviously, the markets reacted favorably, and it was a good week. But also, we had Friday. We just started our really main third quarter earnings season. And that we started with the banks, major banks such as JP Morgan and the Citigroup. But these earnings will continue this week. So we are going to have more financials, but we are going to get into more diversified technology. For instance, we'll talk about Tesla will be upcoming. So now this is like the exciting part of the season starting, although again, it's summertime, but earnings always create some excitement, and some opportunities as well. The other thing I want to pay attention is the behavior of the dollar, especially overnight, what has been happening overseas, and the impact that the interest rates are having on it. So what direction interest rates are going. The last but not least is that we've talked about gamma squeeze, and we've spoken about this for the whole month from end of March, and we kept looking at it in April and May. And we want to see the way the markets are reacting is still a continuation of that explosion of gamma squeeze, and is it the short squeeze, or are we really in a real trend with a momentum? So with that in mind, let's go quickly talk about our economic news. As always, I like to look at under the hood, look at some of the things such as, box office receipts. You can see that, again, it's summertime, schools are closed. And, I think Mission Impossible came out on Friday evening. We are very close where we were when we had completely open economy in 2019. So we've talked about that, and that's a time to look at some of the, again, the movie theater stocks a couple of months ago. We talked about that in May. Of course, now the question we have is the Hollywood strike, and the screenwriters and actors are joining in. So what is happening is you got to be a little aware of with these studios, such as, let's say, Paramount, and be aware how their stock is getting affected. So, and of course, we talk about Disney, and that has been unfortunately in a downtrend with their theme parks. The thing is, I was flying last week, and you can see I was in Denver. I mean, it's packed. People are traveling. But the main thing is you can see the global commercial flights. Actually, we are ahead of where we were in 2019. So you can see the activities are completely back. So what kind of a week we had last week? The main thing, as I mentioned the last week, was the CPI numbers. And everybody was looking to see how the numbers are going to be up, and what about the Fed, what the Fed is how they're going to react. So the CPI number came out, when we look at it month over month, it was more favorable. Expectation was 0.3%. We came at 0.2. Of course, more importantly is the core CPI, which takes out the volatile energy and food components, and they came also favorable. And then the next day, we had our producer pricing index. They also came favorably on the as far as the regular and also the core PPI. One thing on Friday, the markets were looking at was the University of Michigan's consumer sentiment. It's the preliminary, and that was very strong. It's one of the best we had seen at 72. So whenever we look at anything above 50, that means there's enthusiasm and there's the consumers on the positive side. So 72 was a very strong number. So let's go back to CPI and let's look at what has happened as far as the numbers are concerned. You see, we've been since middle of 2022, we've been this downward trend, and now year over year, believe it or not, we're at that 3%. And as you know, Fed is looking at 2%. So I'm going to dive in deeper at this in our lesson of the week to see, again, is this on the surface something that things are completely changing? Are we defeating the inflation? Or there's other things we have to pay attention to? Now, one of the things I mentioned here, when we're looking at, again, the part of the index, the rents are still our biggest component. So it's a 1/3. And they still were up 0.5%, even though they've been the numbers are getting much better, but they're still 6% above on annualized rate when we look at the 3, 6, and 12 months. So till that really calms down, we still have that momentum going. So that has been a very stubborn part of our CPI index. Now, the other thing is the core inflation has been down in several categories. So the main ones, as I mentioned, when we talk about core, is the energy and the food, excluding those. The airfares actually in June came down 8.1%, although I think July will come back up, but they were down 8.1%. The hotels and motels, the leisure, was down 2.1%, and the used vehicles were 0.5%. There is one that the Fed follows very closely, and that's the super core. Now, super core is core, which is the excluded food and energy and other goods, but also the housing is excluded, and that was unchanged in June, and that has been the lowest monthly reading in the past 2 years. So that's one we want to also pay attention. In the last 12 months, prices in the super core category are up 3.9%. So one of the things that the reason the numbers have also been favorable is that the M2, the money supply. And as you know, we went to the tightening. So remember, we were in this easy money environment for the longest time, and that's really the big culprit of the inflation, printing the money. Now we've gone to the opposite way, and that has played a big role. And now you can see the M2 is down 4% versus a year ago. And it's, we want to see if the effects is going to continue and whether it's going to hit that 2% target. So how the markets reacted, obviously, we will talk about interest rates. They reacted very favorably when the numbers came out. And the reason for that was basically the thought is that, oh, maybe this is the end of the Fed's tightening, and the interest rates again is felt comfortable. On the other hand, when we look at, I don't have the charts this week, but I can tell you're familiar with it, with the CME Fed Watch, there is a 96% chance that in about 2 weeks, or well, the end of July, when the Fed is meeting, there's a 96% chance that they are gonna go up another 1/4%. So the question is, which one is right? The markets keep going up, feeling that the interest rates are at the end, but yet the long end, as we will talk and we will see, is telling us that maybe there's a recession horizon. So, but the Fed numbers are telling us that there will be another rate increase. So one more thing we have to pay attention. We always look at the yield curve, and we still inverted, and you can see the spread between 2 and 10 still at, you know, 90 basis point, approximately 94, or I mean 97, which is even close to 100 basis points. So that is telling us, you know, that's maybe another reason the long end, when we look at the 10 and 30 year, we had a nice bounce after it has been a pretty big movements in the interest rates. This week, the interest rate went down. So basically, there is the concern, well, maybe there will be a recession in the pipeline. As I've said it in the past, we might have already had it, and it has been, again, in my opinion, it might have been segmented. So, so that's what the reason the markets are not too concerned. So let's talk about the markets. We've had, you know, last week it was mentioned about usually the week after the end of the quarter, things get a little, I would say a little profit taking. So we had a down market previous week, but this last week, look at these numbers. You know, Dow Jones was up 2.3%, NASDAQ was up 3.3%, and S&P was up 2.4%. So we see we've hit really all-time high, I mean, 52-week high on all of these, and we're close to some of them. We are getting closer to the all-time high. So, so what happened? And in that situation, we look at the charts and to see what kind of a days and what kind of a week we had. Now, when we look at NASDAQ, I believe NASDAQ has been up 7 or 8 weeks out of last 10 weeks. It's been unbelievable, since especially end of May, we've had big movement after the debt ceiling closure, in a sense. So as a overall, the week for all the stocks, we were up 2.63%, and we see that the growth is back in style, and they did a little better than the value, and the small cap growth was the best performer when we look at, but all of them, they did well. Looking at the sentiment, when you look at the American Association of Individual Investors, you can see this momentum going since June. There's been more positiveness after, you know, so much negativity. And again, I would tie it in with we talked about, again, the squeeze part of things, but that uncertainty about the government closing and, you know, the debt ceiling. So you can see that now the spread is actually, it's been much larger than our norm, rather than we usually are at 6.5% spread between the bulls and bears. And last week we were at 22, and now this week is still up there, you know, about 15% spread. So there is enthusiasm. The investors are thinking that, well, the markets are, you know, they're going to be higher in next 6 months than where they are today. This is something that's been going on for a few weeks. That's the CNN, the 7 factors that they use for fear and greed index. We are at 80. It's one of the highest. So I want to show you, again, we're going to look at the charts. We're talking about fundamentals, but also the sentiment looks, again, kind of a little overcooked. So I would not say, you know, be negative, but be aware, be concerned. So once we put all the factors together, the bottom line is, am I going to initiate a new position, especially when it comes to investing or swing trading? Would I initiate something with these high readings? And we will look at the charts as well. Or would I maybe take a little profits? Now, you will notice that once we look at it, I'm not saying short the markets because we still don't have the signals, but these are some warnings. I just want to be aware. We've had a lot of momentum and strength. So I think in the past couple of months, we've talked about that. This is not the time to short the market, but just be aware to take a little bit of profit if you can. And these are the signs. When we look at the Citigroup, for instance, we are not in the euphoria yet, but we are in a higher neutral zone. And look where we were in March, for instance, and that would have been, I mean, in March and then May. If you recall, again, this was the heights of that debt ceiling. So look where we are now. So there's been a lot of positiveness. So let's look at the charts. I want to start with the S&P cash, and we go back to last year, the August of last year, and as you can see, we broke above that high, and basically using Fibonacci, our next target would be in this situation 45.62, and we are not too far from it. As you can see, that's 127.2% extension. And what happens is, if you recall, we've been talking since March, this whole area, and we went back and forth, and that was the squeeze, and this was the coiling. And I mentioned to you, just be aware whichever direction it goes, there's just so much energy. That's the direction you want to take. And you can see once we broke out of this zone and we broke above the 20-day moving average, it has been all but up with so much energy. And that's why we talk about the gamma squeeze. There were so many open interests. And also there was some short squeeze. Again, people were very much concerned about the debt ceiling, and that's how everything just came together. So, and then of course, the Fed chairman came back and said, well, they're going to do two more rate hikes. So that it was giving a little closure and a little certainty for the markets, knowing that where the again, Fed is standing. They did not say we're going to cut rates. They did not say we're going to stop, but that's how the market is interpreting. Maybe this is the end. We're much closer to the end. As far as our squeeze, as far as our Bollinger Bands, you can see what happened on Friday, for instance, on S&P. We went to that the upper edge of Bollinger Band, and we got a little rejected. We are overbought, so be aware of it on a daily charts. Just at least in the short run, Monday might be a little profit taking because we are hitting the Bollinger Band and we are overbought. Now, if we continue doing that, then we will be embedded, and that means you can see there is uncertainty in the MACD. That means we will continue with the momentum. As I mentioned, that 45.62 might be a place that might create a little resistance, but that's what the chart was telling us from Friday. On a weekly basis, we are embedded. So that's a good sign. That means that the strength is still with the buyers. The momentum is up there. You can see MACD is up there. We've been going back and forth with the upper Bollinger Band, but you see the Bollinger Bands is expanding. So that means there's still some power there on a weekly basis. But again, we are hitting that Bollinger Band. So on a weekly basis, again, there's a strength, but on a daily basis, we might have a little bit of, we need a little closure. Now you can see this is the all-time high at, 48.06 or so. So, if we break out, we could go there. But again, let's watch the month, the daily and also the 60 minutes. Now, NASDAQ did something that it is, again, the Bollinger Bands had opened up. There was a lot of strength, but again, the same story. We are overbought. We hit the Bollinger Band, so we might be a little extended in NASDAQ as well. The same thing with the weekly, though, the same theme like S&P, we are embedded, MACD is positive. So the reason I share this is that, again, we don't see any signals or signs of shorting the market. It's still more of a strength. But again, remember, the earnings are coming up, more earnings, and we will talk about the bank sector, what happened. There were some good numbers, but what will happen, that could be a catalyst. Of course, in less than 2 weeks or 2 weeks, we will have the Fed FOMC. But the weekly, we are positive. So if you want to take a little profit, it's okay. But at this moment, I'm not getting a big buy signal. So it's more of a hold and still, while the momentum is good, as I mentioned, you don't want to short it. One thing also from the linear regression channel, as you can see on a weekly basis on NASDAQ, we are on 100 LRC, we just hitting the 2 standard deviations. So we had on a Bollinger Bands, we actually, NVIDIA, which I don't have it, but I'll let you know, like NVIDIA actually on a daily basis hit the 3 standard deviation, and we had not done it in a long time. So once you follow these, standard deviations, for instance, like a Bollinger Band, once you see, if we use the 2 standard deviation, but NVIDIA hit the 3, and then you see a big sell-off toward, on Friday at the end. So that's how the markets, how that probabilities work. And NASDAQ also came to that 3 standard deviation, which was the first time in 6 months. So basically on that 100, we are actually a little extended, as you can see, it's a downward slope. On a 30 LRC though, we are hugging our mean, the best fit data line. So that shows that you still have legs. It can go up weekly, but longer term, we are getting a little tired. So you see there's contradictions. So again, it doesn't tell us short it, but it also tells us just be aware. All right. No, Russell we were in this long range bound, and finally we broke out of that range and we went above the 100-day moving average, and that was a good sign. And we go with the 2-bar confirmation. You can see we went down to, and then we immediately reversed it. So there has been some strength in the Russell. But again, you see Bollinger Band became our resistance. We went outside and came inside. We are just getting embedded right now. So this is the 3rd day. So if we continue, if it comes back, then that's a good sign that Russell is giving us the strength to continue. On a weekly basis, though, what has happened, we did hit the Bollinger Band. We are overbought on weekly. So daily look good, but weekly we still under the 100-week moving average. And then we can see that 100-week is providing a long-term resistance. And this goes back to a year ago. So we haven't been there. So be aware of that, overbought and with the resistance and the Bollinger Band. So just on a weekly basis, we want to break out of that, so to get the confirmation for a new wave of buying. Now Dow is more of a range bound. We hit the 100-day moving average. That created a nice support. We are overbought at this time. We hit the Bollinger Band, and generally when we are overbought, we turn around, we go to that 18-day moving average. So but the Dow did have a nice day on Friday. And the main culprit for that was, as you know, it is the price weighted index. So basically, United Healthcare had a great numbers, and they were up over 7%. Being a stock in the 450s or so, obviously pulled the Dow with it. So that's why the Dow, performed pretty well. Although the other parts of the Dow didn't do as well when we're looking at, except that JP Morgan was actually up nicely, and then they retraced all their gain. But like Citibank or Goldman Sachs and Microsoft, and they were down, so that kind of pulled them down. But United Healthcare was the big part of the Dow pulling it up. Transportation has been our leading indicator. We've talked about that. You see how we went and hit the Bollinger Band, and now for the past 3 years, we've been going down, but we are above 18-day. We are above the 100-day moving average. We are embedded. MACD is still positive. So those are all good, letting us know that there is a strength. Now, on the other hand, opposite is the VIX. VIX has been just settling down. Now, one of the things on Monday and Tuesday, what you could see Tuesday and Wednesday, you see anytime we go outside the Bollinger Bands, we immediately come back in. So that would have told you that, like on Tuesday, we are outside. Just be aware, we cannot stay outside the Bollinger Band. So maybe it's a time to buy the stock markets, because we are going to retrace, and that's where we are. The same VVIX, the volatility of VIX is showing us there's still a little volatility. Again, I've said it in the past with these daytime, expirations, with the daily expirations, it has really done in a way that we have like daily volatility, but not as much volatility for the monthly when we look at the definition of VIX. So things happen within the day, but not much concern. There's a little complacency for the market. So now look at what happened with the interest rates this past week. And we did go outside the Bollinger Band, then we basically became overbought and came down. MACD has, so this is a really nice move. The question is, this move, is that more of a technical side of things? We were overextended on the top upside and now we are coming down, or is this really fundamental? Now the CPI numbers came out, or is that something that gives that comfort to the markets, knowing that the rates, this is the end of the rate hikes? Or also, is it a reason to believe that maybe there's a recession in horizon? So the answer would come from this. Now, on a weekly basis, I mentioned on the technical side, we are overbought, and then we hit that Bollinger Band last week. So we retraced this week. So this looks like more of a technical, again, a reversion to the mean, because we went outside and the same thing has happened. But the bonds also, when you look at the 10-year note, what the 10-year note is telling us that maybe there is a recession and we haven't had it. So this was a huge move, but also, again, you can see we hit the Bollinger Bands and then we became oversold and MACD crossed. So it has some legs, but we need the confirmation of 2 bars above the 18-day, and we've got the 2, but I'd like to see the 3rd day, which falls on the weekend, to see if there is another chance for the bonds to go up. Now, on a weekly basis, again, I talked about technical side, we are oversold, now becoming a little embedded. So we had a bounce of the Bollinger Band, and we have the 18 weeks moving average as a resistance. So we are not out of woods. The same thing on the long term, you can see the 30-year bonds, we are just hugging that 18-day moving average. So we need really confirmation to stay above this, and the next will be 100-day. Otherwise, this was just a temporary reflection of the CPI numbers and what has happened as far as assuming that the Fed is at the end. So we'll see how it happens with that. Now, the consequence of these interest rates, what the overseas markets are telling us, that yes, so the rates are coming down, and you can see this big drop in the dollar. So the dollar was telegraphing that maybe the inflation numbers are not going to be as strong. So we've had a big sell-off, but this is, as you know, 199.7 is a big support for me. So if we can stay above this, then that means the dollar we keep, consolidating. If we break through this, then I would be a little concerned, which obviously it will bode well for commodities and other currencies. It will also bode well for the lower interest rates and the markets. I would be concerned when we hit about 90 area, 87 to 90. Now that could have a fundamental economical effect. But at this time, we'll see if we keep that support, which all affects your decision-making about the gold and other precious metals. Now, we are oversold, but we are getting close to becoming embedded. That means we're going to stay in this zone. We're going to come inside the Bollinger Band, and then we're going to stay for a while. On a weekly, I want to also check to see we just broke under the 100-week moving average, and we're outside Bollinger Band. So we might have a little retracement back. So next week will be a good time to see. Now, the opposite is obviously Euro, which is the biggest part of our dollar index. And basically, you see you're the opposite. It's been going outside the Bollinger Band. Bollinger Band is opening. We are overbought, but it looks like embedded. So there could be strength in euro as well as, let's say, British pound. Now, Japanese yen has been weaker. We don't have it here. Canadian dollar was strong, but they are retracing. They went way outside their Bollinger Band. So, and that brings us to gold. As you can see, gold has been weak in a consolidation mode, basically for the last couple of months. It's been under the 100-day moving average, and this week, because of the weakness of the dollar, you see we were oversold, and now we are overbought. So what that tells us, that again, I would be a little concerned at in the short term. We are right against that 100-day moving average, the Bollinger Bands. We are overbought. So although MACD has moved to the positive side, the momentum, although the trend is still negative. So let's wait and see on the gold. Now, on a weekly basis, though, you can see, again, the technical side of things, right? So we hit the Bollinger Band, had a nice bounce this past week, and then it coincides on a weekly, on a 100 weekly moving average and the weekly Bollinger Band. So, and we also are oversold. So let's see if the weekly will overtake the daily and give us the strength. Now, silver had its own thing and was much stronger than gold. We had a really nice move in silver after hitting the 18-day moving average, but we are overbought and we are outside the Bollinger Band. So we might need a little rest and retracement. The same thing when we talk about copper, nice strength right against the Bollinger Band, overbought, and against 100-day moving average. We continue with Bitcoin. Now, Bitcoin, we had actually a sell-off on Friday after we had a wonderful day on Thursday. And of course, this was due to, again, we call it ripple effect. So the ripple, with the SEC rulings had a huge move, and it took some other digital currencies with it and also you could see like Coinbase had a wonderful day on Thursday, and that was because of the SEC rulings. So letting us know that Ripple did not do any wrongdoing in issuing those tokens. But what this tells me on Friday tells us that there's a profit taking in Bitcoin. We've been consolidating. We've been above 18-day. We just went under 18-day, but also the volatility is now narrowing. So you see the bands are coming together. So will this be a consolidation above the 100-day moving average? But it just, again, this is one day, so we need confirmation. But also when you go look at the technical on a weekly basis, you see that 100-week moving average and Bollinger Band has been a big resistance. So basically we like to consolidate. We are overbought, and maybe we go back to that 18-week moving average. Last but not least is crude oil had, again, every time had a nice move. Every time we go to the lower edge of the Bollinger Band, and you can see our support, we have a big bounce. So now we are on the other side. We broke above the 100, and we hit the outside the Bollinger Band, but we are embedded now. MACD is positive. So let's see, would we retrace to 100-day moving average and stay there? All right. So next, let's talk about these expected moves. And expected moves, it's amazing that with the trillions of dollars, with the option market makers, how many times they've really have missed out, and in a sense that I think in the past 5-6 weeks, we've been staying outside our probability zone. And look what happened this week. This is a huge move. So on SPX, we were supposed to have a $59 range, and I believe it was like $104. So we are way outside. Now, this is, again, put your critical hat on and think about what was market telling us the day before the CPI numbers, which is Tuesday. So this is where the CPI number came. On Tuesday, the market was positive. It was a nice day. So Did the market know something, or is the expectations? They knew the CPI number is going to be better than expected. So the market was up, and that's why I want to put everything together after we are done. And on Wednesday, we had a nice bounce, and then Thursday with the PPI number, we had a nice, and then we had a little reversal, which we'll discuss it mainly because of the financial actually reverse, and of course we had Nvidia and a little bit of a profit taking. So so that's one. They're outside of again expected move. The same thing happened in Nasdaq. We are outside the expected move. We did hit the 52 weeks high, but look what we were on again on Tuesday. Tuesday we had a nice up day, and then Wednesday we went right to the edge of the expected move. And we would expect that, you know, if the market makers are correct, we will have to stick around here, but then it's almost 2 standard deviation movement. So the Nasdaq was also telling us that the inflation numbers could be better than expected. Then we look at the Russell, and Russell had a really good move just from the beginning of the week, and then we've been consolidating again. That's a 2 standard deviation. So 343, the market makers have been wrong. Then the Dow also had a nice move on Tuesday, and then we've had up move on Wednesday, Thursday, Friday. On the other hand, the bonds also telegraphed on Tuesday. They were up, and of course, the inflation numbers came softer. So here you have all these markets. We have the financial markets, and we look at the stock markets, and then the other side of the financial market, we are looking at the bonds. And the bonds are telling us that there was expectation of a positive reading from CPI. Let's go to the other side, look at the dollar index. What happened to the dollar? The dollar gave us a negative reading, and they were telling us that, you know what? The interest rates could go down, so the inflation number could be tamed. So all of a sudden, you have all the factors coming in before even going on the CPI number. So I'm not sharing this. I didn't put it in our trade of the week, but I did go long before the CPI number came in on my Apex account, and was able to come close to funding it. So precisely these are the interpretation you can make. So you see that again, confirmations. And obviously, because of the weaker dollar, gold was up. And as you know, the higher interest rates are not good for gold. So they like that the lower rates. But and then silver was in its own zone. This is almost 3 standard deviation move. And then the financials obviously had, this is a little concerning, by the way. So let me talk about this. So you see financials were nicely up. JP Morgan came, it was the best quarter I think they either ever had, or it's like in 14 years. And the big banks are in pretty good shape because of the net interest spread. They're doing well, you know, with all the higher rates. But other banks didn't do as well as JP Morgan. So of course, with JP Morgan, one of the things was the First Republic. The purchase of that helped them get their earnings. And so the regional banks still have difficulties. The larger banks have been pretty healthy, but this was a little concerning that on Friday we have this big reversal. So pay attention to that, because we got more banking numbers, you know, talking about Bank of America, for instance, and Morgan Stanley, and we want to watch for those. And then and energy also had a reversal on Friday, so that affected the S&P toward the end. You could see that. All right, let's talk about some lessons on the emerging markets, and basically put our critical hat on. So far, you can see this is as a Wednesday, and majority of markets around the globe, they're on fire. The few that we have are negative. It's interesting that Great Britain just went to negative, but mainly in Asia, we have Hong Kong, we have Indonesia, we have Malaysia, and the worst performer is right now is Thailand, and we'll discuss actually right after this. On the other hand, you see big numbers when it comes to Taiwan and semiconductor related, but look at Argentina, 113%. And then you look at Egypt, 17%. So there's a lot of big numbers there. Just consolidate. This is our 6-month chart for all the international ETFs. So I'm using the 20 and 50-day moving averages. So just visually to see where some of the markets are. For instance, we see China has been consolidating on the downside, but on the other hand, when you look at Europe, Americas, and Far East, for instance, Australia, Europe, and Far East, we can see they're in a uptrend. You look at, for instance, Italy, and basically, this just visually you can see where the strength is and where is the weakness. You see Hong Kong, for instance, right next to Hong Kong is India. Look at this beautiful chart, that 20-day moving average. What a beautiful support it has been. So speaking of Thailand, you know, we've been positive from the tourism point of view, and there is a movement from the geopolitical side. The political side, there was an election, they just had it, and Pita Limjaroenrat is a young man. He is in charge of the Move Forward Party, and they are anti-military and anti-royal, the monarchy movement, and they won the most seat in May 2023 elections, but they did not get the majority. So there was another election, so they had to do a rerun, and they still not there yet, because what happens is, again, the Thailand, so we have the royalty and we have the military, and royalty is really just a figurehead, but the military runs it. But we see this move forward has a coalition of Shinawatra. That was the prime minister. We had a Shinawatra prime minister. So this party and them, they are 42%. So there is an election coming up on July 19th. So you want to pay attention to that. But military plays a huge role. So they need more seats to become in the majority. But right now, the power is with the military. Switching from that, completely the other side, it's more on the policy than actually what is the fundamental reason I'm sharing this with you about the climate financing. You see that in North America, 96% of the financing comes from the private sources. We go to Europe, there's 59%. But as we're moving up and up, there's less private funding coming. That means there's less belief in success, and there's a lot of money is just thrown to the public. Now, the problem is the experience I've had, there's so much bureaucracy, it's more of a feel good. So Europe has invested lots of money in Africa with no results. So all of a sudden, when we go to climate financing, we see there is very little interest from the private sources, only 14%. The rest of the money is coming from the public resources, and that does not give us much confidence. So the idea is we want to make sure there's more private funding coming because they believe the projects will succeed. And again, the layers after layers of the bureaucracy, and corruption, obviously. So this is, again, I want to put your critical hat. It's not about just giving you the numbers. I just want to look at the policies and the philosophy, why some of the places do not succeed. And this is one of the reasons. On a positive note, though, I thought this will be interesting talking about Ethiopia. There's 23 companies in Ethiopia, and they're the 7th largest producer of cement with the $2.5 billion valued for the East Africa, which is the 3. Ethiopia is being the largest as far as the production. Egypt is by far the largest in Africa. But the good news is you want to watch things like this. I know everybody is really loving art, AI and robotics and what's going on with technology. But based on my experience, it's almost 40 years, some of the most boring investments have been the best investments and have given me the best clues. I've used this many times before, if you remember Hansen's and the Monsters drink, for the decade of 2000 to 2000, actually to 2018, 2019, from 2000 debacle, the best stock was the Monsters drink, and that was up 40,000%. People think about Apple, they think about Amazon. And cement companies, when you look at, especially in emerging markets, there's a lot of indication that there are the sign of what's happening with the true economy. So a lot of times is the profit margins are very strong, and of course the big contracts come in with it also tells you what's happening with infrastructure. So don't ever neglect looking at some boring companies, like one of the things I look at Mexico, for instance, I look at the Mexican cement company to see what is really happening with their economy. So anyway, just out of the box, just letting you know, there's companies like in Ethiopia working on cement. Moving to crude oil, and here we are talking about Iran. Iran is the fourth largest holder of reserves, oil reserves. Now, as you know, there's been sanctions regarding Iran, but this interesting thing is they're producing 4% of the global output, but they've been exporting regardless of, again, with the sanctions. And the good news is obviously through China and of course, Pakistan's ex-prime minister on. What happened was they broker, so supposedly Saudi Arabia and Iran are coming together. Of course, these are the two powers in the Middle East. And through that, obviously, Syria, which has become a big issue, and of course, Yemen. So they think they're resolving that, and Iran is thinking that, maybe they have more of a consolidation with Europe about the nuclear plants. But interesting thing is, again, Iran is exporting regardless, although there's the sanctions. And that's one of the reasons you can see that despite these big announcements from OPEC Plus that they're gonna obviously limit the supplies, you see the price of oil has not moved much. And of course, we talked about Russia a lot. So Iran is another culprit. And as long as you have countries like China and India, they're gonna, of course, want to have lower cost oil. So this is more of out of the box looking at other things. So talking about looking at Iran is considered a frontier market. We talk about Armenia. So this is a headline I'm going to read to you. The jump in Armenia's exports to Russia closely follows a rise in imports from the West. So the reason I want to show you this, look at this big jump for 2022. The GDP grew by 12.6%. So what they have done after the situation in Ukraine, they have started exporting to Russia. And of course, many Russians have been moving to Armenia as a sanctuary. So what is happening is, well, there's obviously the production, but what Armenia has been doing, they've been importing from US, UK, Japan, and top 20 EU economies and turn around and send it to Russia. And remember, Russia is under sanctions. So that's how they went to 12.6%. The question is, I don't think they're able to continue that. I mean, that's, again, maybe close their eyes temporarily, but I think that will be changed. So they will not see this 12.6%. So if you're planning of investing in Armenia, I would, again, put my critical hat and say, well, not just look at the numbers, you want to see where those numbers came from, and that could be stopped. The other part of it, again, the critical thinking I want to put on is completely outside, nothing to do with economics, but it is about the news that you're reading. And the news, especially, let's say, with the Russian propaganda, You know, the first month, Russia said that they had only, the death were only 5,000 or 5,600. They really downsized it. So the way I want to look at it, don't listen to the news. So one of the ways you have to go around and look at, for instance, this is a weekly probate cases. How many reporting has been based on the probate? So it is real and it is public numbers. So as you can see, despite the fact that Russia has been underplaying, there has been almost 47,000 combatants have died because of, there's been a lot of probates, especially for the 20 to 24-year-olds. And as you can see, the invasion has at least doubled Russia's total combat losses since 1945. And that's the morale of the soldiers, right? So they are really the victims. And this is what has happened. This is the low end, 40,000 till May 27th, and the highest one is actually 55,000. And when you look at the Chechnya or Afghanistan, and I mean, by far it is the biggest, but obviously they have been underplaying. But I'm saying one of the ways, again, when you're doing like a stock analysis, you go and talk to, you know, we talk about customers, and but you look at the suppliers and other things. So just don't go with what the numbers that the company is giving you or their annual reports with the earnings coming up. You've got to dig deep. All right. So that was our emerging markets. So some of the lessons for this week is just a little chart. You can see how since 2000, how we've had such a nice bull market in the treasuries, and of course the stock market. It was the decade of the lost decade, 2000 2010, but since then we've had a beautiful uptrend. Of course we had the COVID, looks like a hiccup right now, and then of course the 2022 we had a nice, but you see that inflection point now with the higher interest rates. You see the divergence, and this is obviously the stock market has been doing much better than bonds. This is, I brought this to your attention, I think 6 months ago, maybe in January or so. So I talked about, be aware of the cover of magazines and newspapers. And this is from October 10th. And this is from Barron, and saying the US dollar is a super strong and 8 ways to invest abroad. So remember, this is October 10th, actually originally came October 7th. And this is exactly where the news came out. And this is where we are now. So these are, you know, the barons are supposed to be the authority, and, you know, it's supposed to do all the investigations. So again, just be aware of what's going on. And we've had many of these examples. I go back to 1970s, and you can see from Business Week all the way to Economist in the 80s. So anyway, just read your news with a grain of salt. Just have your analytical hat on. I mentioned about the financials. So the markets were up. I mean, JP Morgan came with the great numbers, and then look what happened to financials on Friday. We had a big reversal, and only JP Morgan was a winner. So Citigroup had some problems, and, you know, so look under the hood with these financials. Again, don't take that on the surface. Just looking at the earnings, and of course, they've had great revenues because of the net interest. But some of the biggest culprits, especially like for Citibank, was their trading losses. So that's something you want to think about. Another critical thing, can we talking about CPI? The numbers came obviously very attractively, and they were supposedly caught the market by surprise, which you could see on Tuesday. They already were preparing for that. And again, I've talked about this in our, I think in January, we talked about that. That remember, when we look at the 12 months, it's a rolling. So 1 month drops and the next month adds up. It's like the moving averages. So this is where we are. And you can see in 2022, we've had this big upper movement in inflation, the CPI numbers. And this is where we are in the 2023. So you have to remember, every time that we, let's say we add this, we drop this number. So the higher the number, which is dropped, actually the lower the gap and the lower the moving average. So this is the inflection point. This is June. And I think, again, a couple of months ago, I mentioned in our main numbers, I said, please be aware, June is a big number. Once it drops, the inflation numbers are not going to look comparably on an annual basis as good as they have been looking so far. So you see the gap is closing, and now we are flattened. So remember, we're going to have flat number for July. This is going to drop. And even if we stayed flat or went up a little bit, we will have a bigger gap. So that's the reason you see this gap, again, based on moving average. We went from 6.4 to 3 because we were dropping big numbers. We go back to 2021 and 2022. So that's where this huge gap happened here, because we had a big movement in 2022, and that was at 9.1% in June. Since then, the 2022 continued going higher, and one of the biggest culprit, obviously, you remember, was the oil and food prices due to Ukraine war. And then 2022 has been flat. So that's the reason you can see we are dropping big numbers and the direction has been going down. So what now? Looking at the future now, if you have this steady movement in the 2023, but yet dropping these numbers, that the projection is, if the trend continues, we're actually going to turn around in July and start going up. And by December, we can go back to 4.3%. So it's not just about absolute numbers and what the market, it is more of what we want to believe and also what we expect, what we forecast. So again, so just be aware of this. It also gives you the, for day trading, it also could give you a little heads up. So anyway, just thought to use that. Other thing is, another lesson that we have is the government receipts. So every time US tax receipts have tumbled this much, which we have it now, the US was in deep recession, So basically you see we were in recession and it continues. So this could be after facts. I don't know. I still think, again, we've had a segmented recession. So I'm not sure if we're going to have a deep recession coming up all at once. But if you talk to some individual, some small businesses, they feeling a little pressure. But at this moment, obviously employment is strong. But again, I'm just sharing. My job is to just at least offer you some of the information out there. And you can see what has happened in the past when we have gone below that 0%. The consumer sentiment, as I mentioned, it was pretty strong, and that's just a little history, monthly and 3-month average, so you can see where we are and where have we been in the past and how we have reacted. So obviously the 2020 was a big hiccup, of course, with what happened. The last one, let me see if this is the last. No, I still got one more. But the last one, I want to also look at the breadth. So the first 5 months, what you could see, and we talked in detail about 100% of S&P 500 gains were driven by 10 largest mega caps, right? So we have the Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta, Tesla, Broadcom, Salesforce, AMD. So they all contributed to all the growth that we've had in S&P. And all others were actually even negative. They did nothing. But since June 1, again, I go back to that debt ceiling conclusion things. Look what has happened now. The markets actually, the big top 10, they have contributed 1/3 now, and the 2/3 is coming from the other stocks. So that's just so that's good news, because now we are getting more players. So the breadth is working nicely. But the thing is, though, it's the summer doldrum too, so we'll see what happens. Yeah, that's our last lesson. So completely different. Let's talk about World of Soccer. I thought you might be interested in knowing that FIFA just paid out $209 million to the clubs whose players were competing in the World Cup. Of course, not a surprise that Manchester City, they had the highest number of players, and followed by Barcelona and Bayern Munich. Manchester received almost $4.6 million, and Barcelona received $4.5 million. So what they have done, so this is the rules. FIFA pays $10,950 for each of the 837 footballers at the World Cup, regardless. So this is important, how many minutes they played during the tournament. So what happens is, basically, that's why it's important to make the World Cup, so you could be injured and still, be on the roster and get paid. So these are distributed to the clubs, and then the clubs pay the registered players for the past 2 years that they've been playing for them. Now, in 2018, there was only $8,530, and well, so you can see it moved up about 25%. That there was a 46 English clubs that they received funding, and they're the largest recipients, and they received 37.7 million. Spain was second, Germany, Italy, and France. So the top 5 of Europe, as you can see. Now, that money from 209 million, they're going to go to 355 million. So just a little information on that. So quickly, I'm going to move to our trades. Please, again, the gaps, be aware of that. I'm just repeating every single week. So what happened this Friday, you see how nicely we had a gap up, we filled it, but guess what? We have open gap of Thursday that hasn't been filled. So just put it in, somewhere, just have the numbers. And also Wednesday, we had that big gap of the CPI gap, more professional. We could not close the half a gap. So just have it back of your mind that there's a possibility we could close that gap. The other thing is, I've talked about the put-call ratio. This is the index and equities. So we are in a kind of extreme below the average. So just watch for that, a little complacency. What that means is more premium gone to calls versus the puts. So there's optimism, and I put these are when we go to extreme upside, you see we've had a nice move up, but when we touch that average 70, what happens is we actually get some correction. So we are there, the markets have been moving up. There might be a little complacency in the short run. The other thing of the trade, we'll go back again. If you follow just 4 or 5 strategies, you could be pretty successful, especially in day trading or even if the swing trading. Again, this is our 5-minute bar for the CPI. Again, we are the lower edge kept. That was the low of the day, and as I show you, the low of the week, one of the following days. And you see we broke out and basically created a nice support for the rest of the day. And also the 50-bar moving average was nicely done. When I go to using 15-minute bar, you see this is the next 3 days. So Wednesday, Thursday, and Friday, that became our very nice support zone. And also the 50 and 20-bar moving average have become very good support. So just following that, you could have done some nice day trading. ETF of the week, that strong ETF for the week was ARK FinTech Innovation. They were up 12.8%. The down was the insurance ETF, was down 2.1%. Another ARK Next Generation or Internet Fund was up 12%. And the insurance ETF KIE was down 0.6%. One thing I want to, another ETF, I would just, from just a technical point of view, as you know, Healthcare is more defensive. They're actually down 3%, while the markets are up 16% or so. But we are getting close to a wedge. So you see those moving averages are really consolidating. So we are moving to some kind of a squeeze. So watch for a breakout. So fundamentally, it might even make sense if there is going to be some correction in the markets, the money could move to some defensive stocks, so sectors. So just watch this, just put it until we get a breakout, either one. So you can see what a strong resistant trend we have here. So just be aware, if you can break this, it could be a nice move up. So just a food for thought. Stock of the week, as you know, for the last 2-3 months, I've made a case study of Tesla, and it goes back to right around here. And when we had right around here, end of April, the last earnings, so it's almost 3 months, and we had the gap down. We went to the following previous quarter of January. We thought that would be a place to have a support. And since then, we've been watching Ichimoku. You can see this was the gap. And then this one, you see that ADX, the trend got stronger. We already had the cross of the DMI negative, positive over negative. So once we broke above the cloud, the rest is history. And our lagging line broke above the cloud. So that's all confirmation. We did have retracement, and then we broke off that support, and here we are. So word of caution is, there's the earnings coming up. So I'm just giving you a heads up. On a weekly basis, again, we broke above the cloud on a weekly basis. You see, again, at this moment, the DMI positive crossed the negative. We broke above the trend line. And now we've had two bars above the cloud, the weekly one. So that was a confirmation. So it's just, again, reviewing what the things could happen. Now, about 5-6 weeks ago, I mentioned to you about seasonality of DXCM. It's more of a diabetes, and somewhere around here. So if you recall, so we've had a really nice move since then. We broke above that resistance. We've been back and forth. So just something about seasonality. Speaking of seasonality, I just want to show you again, like on a weekly basis, this is how nicely we kept that moving averages. So it has had a nice seasonality move on DXCM. Now, crude oil, historically, when it comes to from mid-June to mid-August, has negative seasonality, and just watch for that. Although you could see, we had a nice bounce up this past week, but we will have these up and down. But when you go back the last 10 years, you see what has happened, and as far as this almost like a 2 months window. So watch for that, because that brings me to ExxonMobil. You see Exxon, except 17 and 18, has had a really downtrend. So just a food for thought. This one goes from mid-May to mid-September. So another seasonality play could be ConocoPhillips. Again, last four years, we've been pretty negative during this window. So just a little heads up, just a little, some candidates. The last but not least is I chose S&P Mid-Cap 400 for our squeeze play based on their setup. So some candidates for you for over the weekend to look at. And the last thing will be just briefly, I want to keep it short. I went a little over. Just watch again. I mentioned Morgan Stanley and Bank America Tuesday. That's a big one. And IBM and Tesla. Those are big for Wednesday. And then we get to more medical, Abbott Labs and Johnson & Johnson, American Express, and Schlumberger. So with that in mind, I hope it was informative. I appreciate you being with us. I'm going to go ahead and stop the recording and open up for any questions that you have.